In this video, let us learn about the bond yield and related measures. A bond's yield is the annualized rate of return that an investor can expect to receive from the bond if it is held until maturity. A bond investor can expect to receive a return from one or more of the following sources: the coupon interest payments made by the issuer, any capital gain or capital loss when the bond is sold, and income from reinvestment of the interest payments, that is interest on interest. The three yield measures commonly used by investors to measure the potential return from investing in a bond are coupon yield, current yield, and yield to maturity or YTM, which is the interest rate used to discount the cash flows for valuation of the bond. Coupon yield is the coupon payment as a percentage of the face value. In other words, coupon yield refers to nominal interest or fixed return paid by the issuer. Coupon yield does not reflect the impact of interest rate movement and inflation on the nominal interest that the government pays. Coupon yield is calculated as. On the other hand, the current yield is the return the bond holder gets against its purchase price, which may be more or less than the face value or the par value. The current yield considers only the coupon interest and ignores all other sources of return that will affect an investor's return. Current yield is calculated as. The difference between the coupon yield and the current yield can be easily understood in this example where a bond is trading above its face value. The coupon yield on the bond stays 8.24%, while the current yield falls to 8.00%. The yield to maturity, YTM, is the expected rate of return on a bond if it is held until its maturity. It is the rate used to discount the future cash flows from a bond to get its current market price. YTM is also considered the internal rate of return on the bond. The YTM can be calculated using a manual, trial and error method, or by using MS Excel. Using the MS Excel, the yield of periodically coupon-paying securities, given the price, can be calculated using the function yield. The price and yield of a bond have an inverse relation. This means that if price goes up, yield goes down, and vice versa. A bond trades at par value when coupon equals prevailing interest rates for the bond's maturity. Higher interest rates mean low prices for existing bonds, as new bonds will pay higher coupons. Lower interest rates mean higher prices for existing bonds, as new bonds will pay lower coupons. Thus, bond prices and yields keep changing constantly, affecting the returns received by the bond holders.